you've got questions, well, we've got answers in the form of Jeffrey Levine from Buckingham Strategic Wealth for another edition of Ask the Hammer. So, Jeffrey, we have a question about the current environment. We're in an environment in which there are historically low interest rates, and people are wondering what to do with the fixed income portion of their portfolios. Any thoughts?
Yeah, first off, I'm not surprised that you're seeing that question. It's one of the most common questions that I've been getting recently. And it's understandable because for years we had low interest rates and we said, wow, they can't go any lower. We can't go any lower. And as I sit here today, mortgage rates are once again at their historic lows. So obviously good if you're buying a house, but if you're a retiree or someone who's looking to live off of your pot of money and you're trying to generate yield, it's really, really difficult. And so what do we do with the fixed income portion of the portfolio becomes a very important question. I'll say that there's no perfect right answer or perfect wrong answer, but I think it largely comes down to what is your philosophy about fixed income? For instance, some people look at fixed income and they say, I need X amount of yield from my fixed income in order to make my lifestyle work, in order to generate the type of income I need to meet my expenses, etc. There's another school of thought, though, that says, look, it doesn't matter what fixed income is yielding. Fixed income is there as a safety net. And so when you look to generate X amount of yield from your portfolio in a low interest rate environment, it necessarily means taking on more risk, whether that may mean more credit risk, in the form of lower rated companies, whether it's more duration risk in the form of going out longer on your fixed income investments. So it really comes down to what philosophy you believe. Now, if you're looking and saying, well, fixed income is just my safety net, it doesn't matter what the yield is. You still go with the very safe investments. For instance, you look at things like CDs or AAA, AA, even maybe single A rated bonds, whatever your comfort level may be. But you're not saying I need X amount of yield. You're saying I need this safety net, and then we'll deal with whatever the outcome is. And then there's the opposite, right? Which is I want X amount of yield from my fixed income investments. And while that may be understandable to support a lifestyle, again, it also increases risk in the portfolio necessarily in an environment like this. So you have to then decide what are you going to do with the other portions of your portfolio. Do you, for instance, dial down some of your equity risk so that your overall portfolio maintains with your overall risk tolerance? One other thing you might consider is what other very safe investments are out there. And obviously very safe is a relative term, just like, risky or conservative. Different things mean different things to different people. But we could look at, for instance, replacing a portion of a fixed income portfolio with perhaps an income style annuity like a SPIA or a qualifying longevity annuity contract, which, while not fixed income by themselves, are essentially you can consider them to be fixed income alternatives in a portfolio. Or you may even look at fixed or fixed indexed annuities in the right circumstances. It all depends upon what your goals are, how comfortable you are with tying up money. And these sorts of things are what you have to look at individually for your own goals and for your own desires, for your own liquidity concerns. Again, in an environment like this, the key thing to remember is there is no perfect solution. It's just a matter of choosing the one that is least bad for you. And so that's what you've got to go in with the mindset. I'm going to choose the one that is least bad. We'd all like from our fixed income portfolio to be able to stick money in a bank and get 5% from a CD. It's just not going to happen anytime soon.
So one quick follow-up, Jeffrey, is this. I often think that people are focused on the nominal yield, but also need to look at the real yield, right? The nominal rate minus the rate of inflation, which in some cases, if it's positive, it means that you're faring better. And if it's negative, obviously you're doing worse.
Yep, absolutely. So ultimately it's not, you have paper losses and you have actual losses. So, one of the things a good example of this would be, some people look at a bond yielding 7%. They say, oh my God, this is amazing. This is great. But if you're buying the bond at an excessive premium, it's really not as good, right? Because your premium is going to amortize over time and you're going to end up, having that bond redeemed probably at par. So it really depends upon Well, I guess to your point, you have to look at the bigger picture. We've got to look at what is your real return. Even things like dividend producing stocks. I had a good client of mine a number of years ago. He refused to sell stock that was producing a high dividend, even though year over year, the company was actually losing money. Its stock price was declining. But he said, but it's producing such a great yield. I said, yeah, they're giving you 7% a year or 8%, but you're losing 10 or 12 in share price value. And he just had a very difficult time. It took a long time for me to finally convince him that that was not a good investment. When he realized, gee, I guess my stock price is really kind of low. And so it's one of those things where, is it a true return, or are you getting it on one side because it's being taken away on another? And oftentimes with fixed income in particular, that is the case by its very nature, right? There's two components of your return. There's the yield that you're getting, and then there's the actual price of your investment. And you've got to take both into account over the long term.
All right, Jeffrey, nailed it again in this episode of Ask the Hammer. Appreciate it.
Thank you.
So, Jeffrey, before we go, if people have questions to ask you, should they email you?
Yes, we want to hear your questions. We want to know what's on your mind. So if you've got a question you'd like us to answer on one of our Ask the Hammer segments, go and email us at askthehammer@buckinghamgroup.com. Again, that's askthehammer@buckinghamgroup.com, and we'll be happy to answer as many of your questions as we possibly can.